this video, we will see about the secondary market, particularly the role of secondary market, and then the stock exchange, and then the stock trading. Particularly, we will see about what is this contract note, and then the products that is sold in the secondary market, mostly shares and the bonds, and then we'll see in detail about the equity investment, and then the debt investment. So we already know, right, what is this secondary market. So the secondary market is a market where the securities that are already sold in the primary market are being traded. Okay. Particularly the majority of the trading majority of the trading in India is being done in the secondary market, and secondary market contains two types of products, that is equity and then the debt. So what is the role of this, okay, secondary market? If you could say, for the general investor, there are two angles to see the roles. One for the general investor like you and me. Another one is in the case of the companies. For the general investors, it provides a platform for trading. But for the companies, this actually serves as a monitoring and control indicator. How you can say like this? For instance, um, sorry about this. Okay, let's say how it is actually acting as a monitoring and control indicator. Particularly, companies nowadays are focusing, instead of profit maximization, they are actually focusing on wealth maximization, that is maximizing the wealth of the shareholders. So to do this, what they will do is they will sign a incentive based management contracts. So they have to see the performance, like how the secondary market is performing, and if it is performing really well, they will give incentives to the managers who are responsible for that. That's what I call as incentive based management contracts. So this can be done so that the managers who are usually profit minded, or who are focusing more on the profit maximization, can now do even wealth maximization. So this actually serves as a indicator. And another one is, it also serves as a information aggregator. By looking at the behavior of the people and looking at like how my stock performs well in the market, I know like how my company is being valued by the different stakeholders. So in a way, it is like a information aggregator for me. So in this way, for the company, the secondary market is actually helping. So these are the two roles I would say for the secondary markets. Now let's see the difference between the primary and the secondary market. What are the major difference between the primary market and the secondary market? We already know this. So in the case of primary market, the fresh securities, a new issue of securities will be done. But which are securities is already sold in the primary market will be traded among investors in the secondary market. And also a secondary market can be either auction or dealer market. Okay. Usually auction, if you could say, it could be stock exchanges, whereas if you take dealer markets, it would be OTC, over the counter markets. Now let's see about stock exchanges, which is actually doing auction based transaction in the secondary market. So what is happening in the stock exchange? So the stock exchanges are under the supervision of SEBI in India, Securities and Exchange Board of India. It actually provides a trading platform when the buyers and the sellers will meet to transact the security. Um, Mostly this trading platform is an electronic platform also. Okay, and wherein okay, these buyers and sellers trade through the computerized trading screens available to them, which are provided by the trading members of the stock exchange. And there is something called demutualization. This is a peculiar okay characteristics of okay stock exchange. What is demutualization? Demutualization means a legal structure of an exchange whereby the ownership and then the management and then the trading all are independent of each other. In the case of mutual exchange, the ownership is related to management and the management is related to trading. Particularly, okay, there will be a broker who will do all the three activities together. The disadvantages in the mutual exchange is that there will be a conflict of interest. Maybe a broker will be attracted to a particular okay company, and thereby he will be he will be doing trading and management, which is biased towards that company. But whereas that is actually being eliminated in the case of the stock exchange because it is demutualized. The ownership, management, and the trading are independent, are separate, are segregated from one another. That is something that I want to discuss. And now let's see stock trading in India. So if you take stock trading in India, usually it is aided by the help of information and technology. Okay, information technology particularly. Previously, it was very time consuming and inefficient, and which actually put some serious limitations on the trading volumes and efficiency. So the automated screen-based trading system, that is screen-based trading system, SBTS, which was introduced by the National Stock Exchange, wherein a member can punch into the computer the number of securities that he is going to buy and also the price at which he is going to transact. The transaction will get executed as fast as possible. And this is actually particularly with the help of the IT revolution. Okay, and there is satellite based client server architecture, which is called NEAT, National Exchange for Automated Trading, wherein the trading information okay will be stored on the client's memory to achieve minimum response time and maximum system stability for the user. Okay, this is yeah. Let me finish this automated trading. So this is actually as an uptime record of around 99.7 percentage. It's very good, right? Maybe about 0.3 percentage is due to some okay maintenance purpose. So this actually has improved the trading volumes and as well as the efficiency as I told before. How to place orders with the broker? You may go to the broker's office or place an order on the phone or on the internet. Okay, and also every investor okay gets access to internet-based trading facility with the help of this two okay system, that is the National Exchange for Automation Trading and then the screen-based trading system. And there is something called contract note. Let's see about this contract note. So it is actually a confirmation okay document, I would say. Confirmation for what? Actually it is for the confirmation of a trade done based on a particular day on behalf of the client by a trading member. So actually it imposes a legal what to say enforcement between the relationship of the client and the trading member. So thereby if there is any future problem that is going to arise or any dispute is going to arise, one can use this contract note as evidence to settle the disputes. It is also a prerequisite for filing complaint, anything or anything against trading member in case of any dispute. So always you must make sure that a valid contract note is present whenever any trading is being done. So the trader as well as the client should keep one copy with each other for any future purposes. Usually the contract note contains the details such as the name, address, CBA registration number of the stockbroker, and also it contains the order number, order time, trade number and trade time, service tax, security transaction tax, signature of the stockbroker, etc. And also there is something called limitation on the maximum brokerage that the broker can do. Maximum brokerage that a broker can charge. So it is usually set at a limit, upper limit of 2.5 percentage of the trade being done. So why should one trade? We will ask like why should one trade on a recognized stock exchange? If you do trading on a recognized stock exchange, in you will get protection in case the counterparty defaults. Whereas this option is not available if you do OTC, over the counter trading. Because in over the counter trading, if the counterparty defaults, then you are at your own risk to retry the money. But whereas this particular thing, that is counterparty risk, is being eliminated in the case of doing trade in a recognized stock exchange. So one can also make sure that the particular broker with which we are actually enabling our trading in the stock exchange is registered with the SEBA. This can be done by checking for their registration ID in the SEBA website. So now let's talk about the products that are sold in the secondary markets. As I told, there are two types of products that is being sold majorly in the security markets. They are shares and then the debentures or the bonds. So if you take shares, what are all the shares being sold typically here? Equity shares, obviously. Obviously we know, right? Equity share refers to the ordinary share, which represents a fraction of the ownership in the company. And then the rights issue or the rights shares. Usually the issue of new securities to the existing shareholder is called rights issue. It is usually done at a ratio. For example, I already told 2:3 means for um, uh, the every 3 shares the investor is holding, you'll get additional 2 shares. Okay, but obviously this comes at a price. Let's say like for every 3 shares, the investor can get additional 2 shares at the price of 125. The reason why the rights issue is being done is because to maintain the to prevent the dilution of the existing shareholders. The dilution is created, then the control of the existing shareholder will get reduced, and at the same time the earning per share for each investor also will get reduced. That is the reason why some management will go for rights issue. And another one is the bonus shares. The bonus shares are aimed at creating dilution in the market, thereby the earnings per share will get reduced. So the shares issued by the companies to the shareholders free of cost based on the number of shares the shareholders owns is called the bonus shares. The bonus shares must be remembered, it is free of cost. And apart from that, we do have a few more things like you know uh, preference shares. So if you take preference shares, these are the kinds of shares that are entitled to a fixed dividend. Um, this dividend uh, should be paid for the preference shareholders before paying dividends to the equity shareholders. They enjoy that priority. And also in the case of any liquidation that is being happening, uh, however their claims will go below the claims of the company creators and the bondholders or the debenture holders. After then only their issue will be addressed. And there is something called cumulative preference shares. That is a type of preference shares on which the dividend accumulates if remain unpaid. Okay, fine. So that is like if I'm not paying dividend, it gets accumulated. That means I'm entitled to pay the dividend, the arrears dividend. Okay, before paying the dividend on the equity shares. So I cannot pay a dividend to the equity shareholders unless and until pay to this preference shareholders their arrear dividends. That is what a cumulative preference share is all about. And there is another product called cumulative convertible preference share. This is very simple. Okay, this preference shares are of same nature as that of a cumulative preference shares, wherein the arrear dividends should be paid to them before paying the dividends to the equity shareholders. At the same time, these shares can be converted into equity capital at any time. And the next product that is being sold is debentures or bonds. So, what is bond? Bond is a negotiable certificate evidencing indebtedness or liability. It is normally unsecured. This is it's normally unsecured. Nobody will give any collateral or any security for this bonds. A bond investor usually lends money to the issuer, and in exchange, the issuer promises to pay him the loan amount on a specified maturity date. So the issuer usually pays the bondholder the periodic interest he will pay over the lifetime of the bond. These are the two typical features of the bond. So there are various types of bond being sold in Indian market. One is the zero coupon bond. So these are the bonds which are issued at a deep discount. So usually okay and it is repaid at a face value. So a zero coupon bond will be having say like 100 rupees value, but when I'm buying, I'll buy at 20 rupees. At the let's say like after 10 years, I'll be getting 100 rupees. This is called zero coupon bond. So here no deep discount and no periodic investment is being made in the case of um, zero coupon bond. So here the difference between the issue and the redemption, that is 80, is the return to the shareholders. And next thing is convertible bonds. So what is convertible bond? A bond giving the investor the price to convert the bond into equity at a fixed conversion price. Right, that's it. So you can convert a bond to equity, paying some conversion price for this. And there is also something called treasury bills, which everybody knows. So these treasury bills are being issued by the government. Okay, so usually they are of short term, up to 1 year. It is issued by the government for financing their cash requirements. Now let's see about the equity investment in detail. So let's see, why should one invest in equities particularly? So when you buy a share of a company, you become a shareholder, and shares are also known as equities. Equities have the potential to increase in value over time. We don't know how much the value will increase. It may increase significantly or it may increase slowly. We never know, or it may fall in value also. But however, the research studies have told that the equities have outperformed the returns of any other instruments in the financial market. So investors buy equity shares or equity-based mutual funds because they are they are increasing in value and thereby it is most rewarding. And another one is they give superior returns than any other investment. If you take let's say like Nifty index in India, it is the average investment return on investment for this is around 15 to 16 percentage for the past 15 years. So that says why equity investment is most rewarding with respect to other types of financial instruments in the market. And also it is paying an average of 1.5 percentage dividends on average for the last 15 years annually. And we know dividend is a percentage on the face value of a share that a company returns to its shareholders. But one must remember that this equity shares are more or most rewarding is most rewarding only if it is invested for a longer duration. This has to be kept in mind particularly. For shorter duration, it is not applicable workable, or it cannot be guaranteed as a most rewarding investment. So let's see what are all the factors that influence the price of a stock. Broadly, you can say there are two factors. One is stock specific factors, another one is market specific factors. So if we take stock specific factors, it is related to it's mostly to do with the fundamentals of the company, like people expectations about the company, and then the future earnings capacity, the management of the company, and then the technology it is having, and then the marketing skills it is having. These are the things that actually says the stock specific characteristics of a company. Whereas the market specific characteristics, it depends usually on the investor sentiments towards the stock market as a whole. Let's say it depends on the entire Indian market as a whole, or the entire Indian economy as a whole. So maybe it depends on the even political factors. It depends on the economic factors. It even depends on the maybe social factors, environmental factors, budget. These are the factors that actually influences the sentiments of the investor as a whole towards a particular market. But however, one must see that the effect of this market specific factor is short when compared to the stock specific factor. The effect is long. So there is one thing we must know. And there are two types of stocks. One is called growth stock. Another one is called value stock. So let's see what is the growth stock. So let's say there are some companies, okay, which have the potential for growth in sales as well as earnings. They're very excellent, when compared to other companies in the market. These stocks of the companies are called growth stocks. These companies usually pay little dividends or zero dividends. But however, what they will do is they instead prefer to invest their or reinvest their profit in the business for further expansion. These are actually growth stocks. But value stock, what are value stocks? So value stocks are no, these stocks are overlooked stocks. Overlook means who is overlooking? Investors overlook stocks. That means they have some hidden value which are not actually being assessed perfectly by the Indian investors. Okay, maybe they are actually beaten down in price because of some bad event. Maybe the industry is not looking attractive to many investors. But however, the company still has certain assets, let's say certain inventories, certain subsidiaries, which really has some meaningful value, which may actually be exposed or come into limelight in the future. But however, at the moment, their value is not being reflected in the stock price. These are actually the value stocks. So value investors look to buy stocks that are undervalued and then hold those stocks till the rest of the market realizes the real value of the company's assets, and then they sell off those stocks. So this is actually the value of the stocks. Mostly this value P bar E ratio will be very less at the initial stage. Later it becomes high. Okay, fine. So now let's see about something called the bid price and the ask price, which you usually see in the stock quotes. So this is how the stock quote will be. There will be a bid side which is called buy side, and there will be another column called ask side, that is sell side. So bid side is the buyer side. Okay. So let's say if you want to buy a stock, then what you will do is you will say I want 1000 stock of, let's say, Tata Motors at a price of 50.25 rupees. That is called bid side. And our side is, I'm already owning Tata Motors stock. Now I want to sell it. Okay, then what I will say is, I'll say, give me 40.65 rupees. Okay, for 2000 stock which I'm going to sell. This is our side. So, and the difference between the bid side and the ask side is called the spread. But before that, if you see the arrangement here, right, the bid quantity and the price, the best bid or the best buy order is the order with the highest price. If suppose, okay, somebody wants to buy from a seller at 50.25, which is highest price, then that is the best bid. And similarly, sell, the best sell is, okay, the lowest price. The difference between this and this, okay, around 9 point something will be coming. That is called the bid ask spread. It is often an indicator of liquidity in a stock. The thing is, usually this bid ask spread won't be, this much, around 9. It will be in terms of some paisas. So narrower the spread or narrower the difference of the bid ask spread, more is the liquidity or highly traded. It is highly traded, okay, stock in the market. So this is one thing, and now we should see a little bit on what is called portfolio. So portfolio is a combination of different investment assets. It can be mixed or it can be even matched. Anything you can do. Okay, for the attaining the investor goals. It depends on the investor. You can do whatever permutation and combination, and ultimately, the items that are considered on a part of portfolio can include any assets. Okay, you own. Maybe it can be shares, it can be debentures, mutual funds, it can be even gold, or it can be even art or real estate, etc. So, what is diversification or diversification of portfolio? So, it is like a risk management technique, I would say. Why it is called risk management technique is because if you mix a wide variety of investments within a portfolio, let's say like I have a FMCG stock, I have a real estate stock, I have a pharmaceutical stock, and I have, let's say, a capital goods stock, which are of okay different okay weightage. So let's say like when FMCG is not performing well in the market, other stocks will give me the return that I expect, or it may be the contrary also. So that's the reason why if I have only, let's say, like FMCG stock, and which is okay, completely 100% of my portfolio, then the chances of my loss will be equivalent to the loss with the FMCG sector is facing. So that's the reason why it's called a risk management technique, diversification, because it reduces your loss or controls your loss. It minimizes the impact of one security on the overall portfolio. So it is only the best way to reduce the risk in a portfolio as of now. And this is one good advantage, mm, why we should have a diversified portfolio. Now that we have seen about the equity instrument, let's see about the debt instrument. So what is a debt instrument? Obviously, it is like a contract whereby one party lends money to another party for a particular interest rate and also for a particular time period. So we actually use okay bonds for the debt instruments given by the governments and debentures for the debt instruments issued by the corporates. So what are the features of the debt instruments? Each debt instrument has majorly three features. Okay, that is the maturity. And the second one is coupon. The third one is principal. So what is maturity? Maturity refers to the date on which the bond matures. Very simply. Or it is a date on which the borrower has agreed to repay the principal. So there is something called term to maturity. Okay, it refers to the number of years remaining for the bond to mature. So term to maturity changes from the date of issue of the bond until its maturity. Term to maturity of a bond can be calculated on any date as the distance between such a date and the date of maturity. It is also called the tenure of the bond. And second is coupon. Coupon is periodic interest payments. It is called coupon. It is actually made by the borrower to the lender, and also it is the rate at which the interest is paid. And principal is the amount that has been borrowed. It is also often called par value of the bond. Usually we represent a bond like this by the bond name like this. So from this we can interpret it's a government security. GS stands for, and it's a central government bond, and it matures on the year 2008. It is having a coupon payment of 11.4 percentage. So this is how okay usually a bond will be denoted. Let's see what are the major segments in the debt market in India. Again, there are three main segments in the debt market in India. One is the government securities, another one is the public sector PSU bonds, and obviously third one is the corporate securities. Usually the market for the government securities comprises center, state and the state-sponsored securities. In recent past, even the municipalities have also begun to tap this debt market for funds. Most of the, not I would say most, some of the, okay, this PSU bonds are tax-free, but most of them are actually not tax-free. Okay, so these bonds typically are structured to suit the requirements of the investors and the issuing corporate, and it includes a variety of tailor-made features with respect to the interest payments and redemption. Now let's see who are the participants in the debt market. Usually we would say like individuals like us and others will be there, but it is not so. Majorly, I would say the dominant guys are institutional investors. If you say institutional investors, that means some financial institution is okay participating. Who are those institutional investors? It could be the insurance companies, or it could be even the provident pension fund companies or provident fund companies. These are the players, or even maybe banks and corporates, the big institutions. They only participate in the debt market majorly. And usually these bonds are actually rated for their credit quality. In India, usually CRISIL, CAR, ICRA, and Fitch. These are the credit rating agencies who rate the bonds. So usually the yield on a bond varies okay inversely to the rating. So that means okay the rating is too good, a triple A, then the interest will be less. If it is okay like junk bonds, okay, where rating is too poor, then the interest will be more, accordingly the risk also will be more. So how could one get this okay securities in the debt market? Again, to subscribe to the issues made by the government or corporates in the primary market. Alternatively, you can also get this from the secondary market. So that's all for this secondary market video. And again, thank you for watching this video.